Good afternoon, everyone, and thank you for joining us today for the tax implication due to COVID webinar with Ms. Pamela Ford. We'd just like to welcome everyone. Make sure you have a pen and a pad ready. You're going to have a lot of great notes to take today. And I would just like to take a moment to introduce Pam before we get started. Pamela has, and my name is Melody McClellan. I'm the CARES Act coordinator for St. Louis. And we also have Tamisha Taylor on, which is the assistant. So if we can do anything, if you have any questions or need to reach out to us, feel free to do that, and our contact information will be shared later. Now, Ms. Pamela has been in the accounting and tax field for over 20 years, entering upon her graduation in 1997 from the University of Missouri, St. Louis, where she earned Latin honors, graduating summa cum laude. She is a certified public accountant who has passed the CPA exam upon the first attempt. Pamela specializes in performing accounting and tax services for small businesses, individuals, and nonprofits, one of which she founded in 2014 that serves the unhoused community for His Glory Ministry of St. Louis. She has served in various roles in public accounting and private industry, to include working from some of the industry's largest organizations like Arthur Anderson and Health Management Associates Incorporated. In her spare time, Pamela enjoys spending time with family, to include her grandchildren, Waverly and Gary the third. Let's take a moment and welcome Miss Pamela Ford, our guest speaker today.
Thank you.
You're welcome.
Appreciate it. Good afternoon, everyone. I just want to thank you for coming and being a part of this webinar. Um, I'm going to try to briefly summarize some of the provisions in the CARES, the Family First Coronavirus Response Act, and the Consolidated Appropriations Act provisions that impacted small businesses relating to the 2020 tax year. So I'm not going to go into depth because these provisions are massive, and they are really, the lingo is very complicated, but I think I have kind of found a way to summarize that information for you in plain English. And this is only related to 2020 tax year. I will note that things are changing, and as recently as today, I received a notification of interpretation by the IRS that brought about a change in the provision. So, please keep that in mind. Please consult an experienced advisor like myself when attempting to apply any of these rules and regulations. So hopefully I'm going to share my screen with you. Okay. And we're going to get started here. So as I said before, can everyone see this? Everyone see my screen? Hopefully everybody can. Caption window. Here we go. Share. Here we go. Okay. So we're working with the CARES Family First Coronavirus Response Act and the Consolidated Appropriations Act, provisions impacting small businesses for 2020. Okay. So these measures were signed into law. HR 748 covered the Coronavirus Aid, Relief, and Economic Security Act that was signed into law on March the 20th, 2020. The Family First Coronavirus Response Act, HR 6201, was signed into law March the 18th, 2020. And the Consolidated Appropriations Act, HR 133, was signed into law December the 27th, 2020. Okay. So the first thing we'll cover is that stimulus payment that everyone received, hopefully in 2020. Some didn't and some did, but don't worry if you didn't. The first round that should have probably been received early on was $1,200 for each individual, $2,400 joint, $500 for each qualifying child. There was a second round um, that was declared in late December. $600 for each individual, $1,200 joint, $600 for each qualifying child. Um, those who didn't qualify for this were non-resident aliens, dependents. They cannot receive their own or estates and trusts. Okay. Like I said, for those who did not receive their stimulus payment, either of these, you are entitled to claim a credit on your 2020 tax return. So no worries if you did not receive either of these payments. That should be covered by your tax advisor. Okay. The next thing we'll cover is a payroll tax credit that is offered under the provisions of the FMLA and sick time. Both of these credits are fully refundable. They are offered to employers, including tax exempt organizations with fewer than 500 employees, but greater than 50. Now, when I say greater than 50, a small business exemption can apply. You have to apply for that exemption. Okay. So the provisions of this give a full credit of 100% of wages for FMLA or sick time provided up underneath the acts related to COVID. Okay. And when I say the credit in relation to COVID, this covers qualifying wages and allocable qualified health plan expenses and the employers, not the employees, but the employer's share of Medicare taxes. And these cover applicable wages or leave from April the 1st, 2020 through December the 31st, 2020. Okay. So for those periods, things might, like I said, might be extended and probably have been. This is only relating to 2020. Okay. This also is available to those that are self-employed, but not healthcare workers or emergency responders. Okay. And so this particular credit can be claimed on your tax return if you're self-employed and you file a Schedule C, or it can be claimed on the 941 for those who file employment tax returns. Okay. So the provisions require the employee must be unable to work or telework or need to care for those related to them who were unable to work or affected by COVID. And so there were like 6 provisions. Okay. So the employee must be under a federal, state, or local quarantine or isolation order related to COVID-19. Or 2, the employee has been advised by a healthcare provider to self-quarantine due to concerns related to COVID-19. Or 3, the employee is experiencing symptoms of COVID-19 and seeking a medical diagnosis. 4, the employee is caring for an individual who is subject to a federal, state, or local quarantine or isolation order related to COVID-19 or has been advised by a healthcare provider to self-quarantine due to concerns related to COVID-19. Or 5, the employee is caring for the child of such employee if the school or place of care of the child has been closed or the child care provider of such child is unavailable due to COVID-19 precautions. Or 6, the employee is experiencing any other substantially similar condition specified by the U.S. Department of Health and Human Services. So, like I said, this is very cumbersome, okay? But basically, FMLA covers a credit for those who are caring for others, okay? And it's a maximum up to 10 weeks of pay with a maximum credit for the employer of up to $10,000 in wages. The sick time can be to cover for any of those conditions, so to care for yourself or for others, with a maximum of 5110 in a credit for sickness related to the employee, or $2,000 in wages for sickness related to someone else. And that's up to 80 hours of full time or 2 weeks part time. So I know, like I said, this is a lot to cover, but these acts are very, very specific. So I kind of condensed it as much as I could. Okay. Then there's an employee retention credit, and this is fully refundable, which means you can get a refund for the balance due if you pay in excess of what the credit allows. And the credit is against employment taxes of 50% of qualified wages, and it depends on the number of employees, and healthcare expenses of up to $10,000 for each eligible employee during all applicable quarters in 2020. This credit relates to wages paid after March the 12th, 2020, and before January the 1st, 2021. The credit can be received if you receive PPP loan. However, the same wages cannot be used to apply for debt forgiveness under the PPP loan. Employers, including tax-exempt organizations, are eligible if they operate a trade or business in 2020 and experience either full or partial suspension of operations during any calendar quarter in 2020 because of governmental orders limiting commerce, travel, or group meetings due to COVID, or 2, a significant decline in gross receipts. Special tests are required. Okay, so that's the employee retention credit. Then we come to the payroll tax deferral. Okay, and a lot of you guys will see this or be asked about this, or should be asked about this. And this is available to all employers, including the self-employed. Okay, and this is just a deferral. So this is different from a credit in that it offers the ability to defer taxes to a later date. Okay, the maximum deferral of this is equal to 6.2 of wages up to $137,700 in wages. Okay, and it's available for wages that were paid after March the 27th, 2020, and before January the 1st, 2021. Okay, and half of so if you defer it and you choose to do so, you must know that half of the deferred balance is due on December the 31st, 2021, and the other half is due on December the 31st, 2022, in addition to whatever you accrue and are responsible for in those years. Okay, so it's something to think about. Okay, the next slide is related to the Paycheck Protection Program and the Economic Injury Disaster Loan. Okay, and so the basic provisions of that, I mean, I won't go into a lot of that. It's cumbersome as well. It's for eligible businesses with 500 or fewer employees, or that qualify as small businesses normally. It's for those who have a principal place of business in the United States, and it may cover payroll related costs. Okay, and there are changes constantly with the PPP loan, okay, that are being implemented. Okay, the biggest aspect of the PPP loan and the EIDL is that the amounts most often were forgiven. Okay, and what the IRS initially had stated, which has been the norm in prior years, is that once you had received a forgiven loan, you would not be able to deduct um, the expenses associated with that loan. So although the amount of the loan forgiveness would not have been included in income, you would not be able to deduct the expenses associated with that loan. So you couldn't double count. So you couldn't not be taxed on the income and then deduct the expenses associated with the funds you received. But the IRS conceded, and so now the IRS has stated that ordinary business expenses for tax years ending after March the 27th, 2020 are now deductible. Amounts that are forgiven are still non-taxable. So you get both sides of it, which is awesome. And just an FYI for anybody that has that and that are or even considering it. I mean, it's an awesome opportunity. And amounts that are unforgiven or treated as true loans, keep in mind that the interest on that will still be deductible. So even if you can't get your loan forgiven, please include that interest on your tax return because it is deductible. Okay. Next item we will cover are retirement plans. There's a new provision that allows taxpayers to take up to $100,000 in coronavirus related distributions from retirement plans without being subject to the 10% early distribution penalty. So it's an opportunity to draw down some money without having that early distribution penalty if you fall underneath the age requirement. And this can be considered a coronavirus related distribution. So you have to be impacted by coronavirus, okay, to be eligible for that. And the distribution has to have been taking place from January the 1st through December the 30th, okay? And the aggregate limit is 100,000, so you can't go over that. You can also recontribute all or part of that distribution within 3 years of the distribution date, and you will not be taxed on the distribution. So repayments will be considered as direct rollovers, and which is awesome. I mean, so think about that. If you've taken a 401k distribution and you want to, you had to have some money and you want to kind of avoid being taxed on that, you can recontribute over 3 years. And if you inadvertently pay tax on the distribution, you may claim a refund of those amounts so you can amend the return if you've already filed. And you can get a refund on those amounts that you paid subsequently. So that's an awesome opportunity. The IRS has also waived the required minimum distribution for 2020. So anyone who is over 70 and a half that may have been required to take a RMD in 2020, the IRS has elected to forego that in 2020. So you are not required to have been impacted by COVID either to be eligible for the waiver of the required minimum distribution. Plan loan limits have been increased to 100,000 for loans from a qualified plan to a qualified individual on or after March the 27th, 2020, and before September the 23rd, 2020. So the loan may be made for the lesser of 100,000 minus loans outstanding or 100% of your non-forfeitable account balance or accrued benefit. So these, like I said, a lot of other technical terms. See your tax advisor or consult me with questions, okay? Plans can also suspend loan repayments between March the 27th, 2020 and December the 31st, 2020 for up to 1 year, although typically those scheduled for 2021 must resume in January. So there's also provisions for that, okay? And you might ask, who's a qualified individual under this? So you are a qualified individual for these retirement plan, except for the required minimum distribution. For these retirement plan special provisions, if you are diagnosed with virus SARS-CoV-2 or with coronavirus 2019 by a test approved by the Centers for Disease Control and Prevention, or your spouse or dependent is diagnosed with SARS-CoV-2 or with COVID-19 by a test approved by the Centers for Disease Control and Prevention, or you experience adverse financial consequences as a result of being quarantined, being furloughed, or laid off, or having work hours reduced due to COVID. You experience adverse financial consequences as a result of being unable to work due to lack of childcare due to COVID, or you experience adverse financial consequences as a result of closing or reducing hours of a business that you own or operate due to COVID. Or under Section 2202 of the CARES Act, the Treasury Department and the IRS may issue guidance that expands the list of factors taken into account to determine whether an individual is a qualified individual as a result of experiencing adverse financial consequences. The Treasury Department and the IRS have received and are reviewing comments from the public requesting that the list of factors be expanded. So, as I said before, things are constantly changing continuously. And as we continue to be impacted by COVID, I think the list will continue to grow. Okay. The last several topics that we'll cover today are charitable contributions, NOLs, interest expense, and qualified improvement property. Okay. There is an above the line charitable deduction for 2020, not to exceed $300 for donations made before December the 31st, 2020. So you would have to have made the charitable contribution before December the 31st. And it's only for those who do not itemize. Okay. So it's like a standard deduction or an itemization. It reduces your adjusted gross income to determine your taxable income. So your tax advisor should certainly be aware of this. Okay. Related to net operating losses for anyone that has maybe had an net operating loss in prior years or may have one this year. The IRS has made some changes, and for tax years beginning before 2021, the 80% of taxable income limitation for NOL deductions is temporarily repealed. So this is a great opportunity to go back and revisit your returns to see if you qualify or if you had any NOLs that you might want to amend. And this will cause that you be able to deduct 100% of taxable income instead of 80%. And for losses arising in years 2018 through 2020, a 5-year carryback is allowed. You can forego this carryback. And this applies to flow-throughs as well as sole proprietors. Okay. For interest expense for tax years beginning in 2019 and 2020, business interest expense limits has now been increased to 50% of the taxpayer's adjustable taxable income versus the 30% previously. So this might not be applicable to anyone on this line, but if it does, that's something to keep in mind. This limit does not apply to certain small businesses whose average annual gross receipts over the last 3-year period or 25 million or less. So like I said, this might not apply to everyone, but it's one of the provisions I needed to cover. Okay, then there's been a technical correction regarding qualified improvement property. I don't know if anyone has real estate or non-residential real estate, but the IRS has made a technical correction, which has defined qualified improvement property as any improvement made by a taxpayer to an interior portion of a non-residential building placed in service after the building was placed in service. This excludes expenditures for the enlargement of the building, elevators and escalators, or the building's internal structural framework. This property was once classified as 39-year property, but now can be classified as 15-year property, as well as subject to Section 179 and bonus depreciation. So these are some things that can bring about some nice deductions. So if you have any non-residential non-residential real estate, please take a look at your returns and ask your tax advisor to assist you in determining whether or not that qualifies to you. Did you qualify for that? I'm sorry. So I'm going to open it up now. If anyone has any questions, please feel free. I know there was a lot to cover.
Pam, do you mind coming on camera, please?
Oh, yes, of course. Just trying to figure out how.
Is there any questions for Miss Pamela Ford today?
Okay, I gotta stop sharing. There we go. Okay.
Is there any questions, Tamisha?
We have no questions in the chat.
Okay, I would like to make sure everyone is aware that we are recording this call, so it will be available. If you want to look at it again, it will be available on YouTube. Again, I am Melody McClellan, CARES Act Coordinator, and we have Ms. Tamisha Taylor, who is assistant. And I want to announce right now some of the upcoming, and you can ask any questions that you would like in the chat. But we have upcoming webinars for March 9th. We have how to engage and align your teams. March 16th, understanding economic injury disaster loans. And then on March 23rd, team leadership, team alignment. And that way, if you're interested in any of the webinars, we can send you the registration link, and we would love to have you to hop on again. And feel free to share with other business owners as well. Is there any questions or any last thoughts, Miss Pam, before we end the call?
Yes, I guess I just want to emphasize the fact that these provisions are very technical. That if there are, if you need assistance or if you need some advice, I'm available. I think my information is on the one of the overheads, correct? Contact me, please, and we'd be happy to assist.
I think
I
we do
think there's
have
a question too.
we
Yeah.
do have a question. Yes.
I just wanted to say a great job to Pam and thank you ladies for offering this service to us today.
You're welcome.
You're very welcome. Thank you. Well, if we have no questions, we've already wrapped up. You can feel free to reach out to anyone on the CARES Act team as well. We want to thank you all for joining us this afternoon. We just give you an opportunity to get back to work and make a productive day. Enjoy this beautiful weather. And thanks for joining us. And we look forward to seeing you on future webinars. Thank you.
Thank you.
Thank you.